Well, good afternoon, everyone. This is Kyle Christopherson with RenPSG, and I'm the Vice President of Client Advancement here. And my primary responsibility, just to give you a little background on myself before we get started, is working with financial advisors, attorneys, and CPAs in developing charitable gifting strategies. And that's a variety of charitable gifts that we work on, whether it be a Charitable Remainder Trust, Charitable Lead Trust, Donor Advised Fund, Charitable Gift Annuity, Pooled Income Fund, Private Foundation, whatever it might be. But today we're going to focus on what the benefits of the Charitable Remainder Trust and Charitable Lead Trust are. And we're a couple weeks before the end of the year, so you may have clients that are contemplating whether or not they want to move forward with a Charitable Remainder Trust or Charitable Lead Trust. So this might be a good opportunity just to catch up on some of the ins and outs of how these tools work. There is still time to get these wrapped up before the end of the year, but it's increasingly running out of time as each day passes. So if you are interested in pursuing this further, please feel free to reach out to us and see if we can help you out and get that facilitated in time for year end. So the first tool that we're going to start off with is the more popular of the two charitable trust types, and that's the CRT. Charitable Remainder Trust, commonly referred to as CRT for short. CRTs are definitely the most flexible charitable planning tool that can provide an income stream to the client while also providing several tax benefits. So if your client needs an income stream, but they also need the tax benefits from charitable planning, such as avoiding the capital gains tax, getting the charitable deduction, then this is definitely the tool that they will want to consider. Here's a flow chart to illustrate the life cycle of a CRT. Now, the first step, in order to create a CRT, an attorney will have to be involved to draft the trust document as well as obtain a tax ID number. Now, RenPSG can certainly help with acting as paralegal to draft the trust document and getting tax ID number, but typically that's going to be handled by the attorney directly. Once this is done, then the client will transfer cash or assets, particularly appreciated assets, to the CRT. And because the CRT is a tax-exempt entity, the client will receive a charitable deduction for their contribution, and the CRT will be able to liquidate any appreciated assets without paying any capital gains tax. The CRT will then pay out the income stream to the client, who's also referred to as the income beneficiary, and whatever amount is left over when the CRT matures is going to be paid out to the designated charitable remainder beneficiaries. Now, the CRT is not going to provide a dollar-for-dollar deduction like an outright gift to charity will. The deduction is going to be equal to the present value of the amount that is projected to go to charity when the CRT matures. So, for example, a 60-year-old client funding a 5% charitable remainder trust will achieve a charitable deduction factor of roughly 38%. And so this means that for a $1 million contribution to this 5% CRT, the client would receive a charitable deduction of approximately $380,000. Once the charitable deduction is calculated, all the normal rules will apply for claiming that deduction on your personal return, such as the 50% adjusted gross income limit for cash contributions, 30% adjusted gross income limit for long-term capital gain assets. And that's assuming all public charities are listed as remainder beneficiary. So a common misunderstanding that I hear a lot with CRTs is that the 10% must pass to charity, so if a CRT's value gets too low, then it must go to charity at that point. And this is not true, with one exception for a CRAT, a Charitable Remainder Annuity Trust, which we'll discuss later. The 10% qualification test states that when a contribution to a CRT occurs, there must be at least 10% of the gift projected to go to charity by the time the CRT matures. So this is a present value calculation ran only when a contribution occurs, not every year. So once the test is passed for a specific contribution, then the test never has to be passed again. So whatever is left in the CRT portfolio is the amount that must go to charity, whether that is more than the client initially received a charitable deduction on or whether it is less than what they received a charitable deduction on. And in my experience, much more eventually passes a charity than is originally projected. So the key benefits of the CRT are the charitable deduction, avoiding the capital gains tax on appreciated assets, and producing a larger income stream since 100% of the contribution is reinvested. Another key aspect of that is going to be removing an asset from a taxable estate, as well as benefiting charity. So now, since the assets go to charity when the CRT matures, we have to take into account a method to replace the asset gifted to the CRT to the heirs if desired. And a common method to do this is to use the tax savings and increased income stream from the CRT to fund a life insurance policy owned in a revocable life insurance trust, which will pay out to the children at the parent's passing and remove the policy from the taxable estate. So if the clients are uninsurable, then it may be possible to add the children as successor income beneficiaries on the CRT. However, this option will cause a portion of the CRT to be included in the parent's estate. So this slide is a good reference to have on hand when you are trying to determine if a new client or an existing client could benefit from a CRT. The 4 key motivation areas for a CRT for a CRT client are going to be the philanthropic motivations, such as the desire to give to charity, family motivations, such as passing assets to heirs, tax motivations, such as the deduction and avoiding taxes, and then finally situational motivation when the client is at a point of sale with a business or rental property. So the more attributes your client can relate to on this list, the stronger candidate they are. However, it only takes one to make a CRT a viable option to consider. And here's a list of asset types that work well within a CRT. In general, you'll want to avoid gifting deferred annuities with gain as well as contributions from a qualified plan. In addition, you'll want to avoid debt-encumbered assets and assets that produce unrelated business income. Unrelated business taxable income, as many of you may already know, within a CRT is 100% excise tax. So you're basically making money for the IRS. Any income that's considered unrelated business taxable income, UBTI, goes straight to the IRS. Also, when a CRT liquidates debt-encumbered property within a CRT, it's considered unrelated debt finance income, which is just another form of UBTI, and it's the same 100% excise tax. So it is possible to cause a worse tax situation selling a mortgage property within a CRT than if the client would have just sold it outright. So every CRT, regardless of the format used, will have all these traits in common. The CRTs must pay income to at least one income beneficiary, but most often it is for the joint lives of the husband and wife, and sometimes children are listed as successor income beneficiaries. 5% is the minimum distribution rate, and the maximum distribution rate will be dependent upon the 10% qualification test we discussed earlier. Income is paid at least annually, but it could be monthly, quarterly, or even semi-annually. And it is important to note that a client can always delay the receipts of their distribution until the end of the year, but they cannot accelerate the receipt of their distribution. So if your client is unsure of whether they want a monthly or quarterly distribution frequency, they should choose monthly and delay the receipt of it if they want to. And the last point I will mention on this slide is that 4-tier accounting is required for CRTs, which we'll discuss a little bit at the end of this section. So now we're going to spend some time reviewing the various CRT formats and how each are going to work. Now, for a Charitable Remainder Annuity Trust, or CRAT format, the key issues to remember are the fixed annual distributions that must be paid out and the fact that no additional contributions are permitted. In addition, the CRAT format must pass a 5% probability test in addition to the 10% qualification test. And this 5% probability test basically states that there can't be more than a 5% chance of the CRT being exhausted before it matures. And right now, clients have to be at least 74 years old to pass this test. Some new information on Charitable Remainder Annuity Trust, which has made it a little bit more interesting for the case design aspect, is Revenue Procedure 2016-42 really has changed the rule a little bit and provided some new life into the Charitable Remainder Annuity Trust. Basically, what this revenue procedure permits is any CRAT with specific qualified contingency language in the trust document, which states that it is to terminate early if the value of the CRAT immediately before the distribution payment would be less than the 10% of the initial trust value. This will eliminate the requirement for the 5% probability test to pass before you can qualify as a CRAT. So this opens up a lot of opportunities for a CRAT, whereas in today's AFR rate, the Section 7520 rate that is used to complete the charitable deduction calculation for CRTs, in order to pass the 5% probability test, you have to be approximately 70 years old. So now what this revenue procedure does is allow anyone younger than 70 years old, as long as they pass a 10% qualification test, to utilize a charitable remainder annuity trust and get that steady income stream and avoid the requirement for the 5% probability test. And you know, as long as you can earn more than the 1.8 or 2% that the AFR rate is at that point in time, then you're not going to have to worry about terminating the charitable remainder trust early. It will continue on because you're beating the projected earnings rate from the IRS. So here is a list of facts related for a charitable remainder annuity trust. As we said, we're going to skip ahead to this side, someone that needs an immediate income that will never change over time, that's going to be the primary goal. However, I want to take a moment to discuss the danger of contributing an unmarketable asset to a CRAT. If you contribute real estate, for example, to a CRAT that is not producing any income, there is a risk that you could create a liquidity problem with the CRAT because it is required to pay out a fixed distribution amount each year regardless if there are liquid assets or not. So if the real estate does not sell by the end of the first year, then the trustee will have to retitle an undivided fractional interest of the real estate back to the clients equal to the amount of the required distribution. So obviously this is not a simple process, as it's going to require title work and a qualified appraisal, and definitely it's best to avoid this unless everyone involved, clients, attorney, everyone, understands and accepts the liquidity risk. So now we're going to move on to the attributes for a client. We're going to move on to the standard charitable remainder Unitrust. And the reason why we're starting here in the Unitrust world is just because it's the most simple charitable remainder Unitrust format and most closely correlates back to the annuity trust format. And this format is going to pay out a distribution amount based on the annual value of the trust, regardless if it is from income or principal. The distribution calculation is completed at the beginning of the year, so any variations in the CRT value during the year will not impact the distribution amount until the trust is revalued at the beginning of the next year. The standard CRUT format is similar to the CRAT format in that it does provide that steady income stream, but it is going to be variable. So if the value of that standard charitable remainder Unitrust investment portfolio grows from year to year, so will the distribution amount. But likewise, you do have the risk for the value of that distribution decreasing from year to year. The best thing about the standard charitable remainder Unitrust is not just the immediate income and the steady income stream you can receive, but also the fact that you can make additional contributions at any point in time. So it's a great solution for someone that's maybe a charitable remainder annuity trust format doesn't make any sense, or maybe they just want the ability to increase their distribution in the future because they're younger and want to maintain purchasing power of their distribution and keep pace with inflation. The NIMCRUT format is fairly complicated, but I'll try and touch on some of the major points. First, the distribution amount is based on the lesser of the annual distribution amount and the net income generated by the CRT portfolio. So if there is no income available, then there is no distribution available. For example, a $1 million charitable remainder trust with a 5% distribution rate will have a distribution amount of $50,000. However, if the CRT only generated $30,000 in income, then only $30,000 can be distributed to the client. The remaining $20,000 of the $50,000 distribution amount will be added to what's called the makeup balance at the end of the year. And the way this works is if in year 2 the CRT is again valued at $1 million, creating a $50,000 distribution amount, but there is a $65,000 of income, then the client would be distributed the full $50,000 distribution amount along with an additional $15,000 from their makeup balance for a total distribution of $65,000. So going into year 3, the makeup balance would decrease to $5,000 since $15,000 of the original $20,000 was just used up. So this illustrates the point that the makeup balance is designed to, quote, make up from prior year distributions that were not paid out when the available income in a given year exceeds the annual distribution amount. The important point that I cannot stress enough, the client must be okay with never receiving a distribution from their CRT because in reality that is what can happen and has happened. So this format is best suited for someone who is wanting to defer distributions throughout the life of the CRT and receive some distributions based on the income generated. It is also an ideal format for someone looking to contribute an illiquid asset such as raw farmland, because if the asset does not produce any income, then there is no distribution required, thus preventing the liquidity problem we discussed earlier with the Remainder Annuity Trust format, as well as the standard Charitable Remainder Unitrust format. The CRT is really the best of both worlds in the Unitrust family. It starts off in the initial stage as a NIMCRUT format, and then after a triggering event occurs, the CRT will change formats to a standard Charitable Remainder Unitrust at the beginning of the following year. And a triggering event causes the CRT to change formats. It simply must be an event that is out of the control of the trustee and the client. And below are several examples for you to review. The date a client retires is not going to qualify since the IRS will view the client as having too much control over when that happens, unless they have a mandatory retirement age such as a commercial airline pilot. This format gives the ability to defer distributions for a period of time and then receive a steady income stream, which is no longer dependent upon income being created. So who is this best suited for? Definitely someone that wants the ability to defer income for a period of time and then receive a steady income stream. An ideal situation for a flipped chair remainder unitrust is, for example, if you have a younger successful client that's trying to save up more money for retirement, this is a great way that they can make annual contributions of cash or appreciated assets, defer income until their retirement age, and have the triggering event as their 65th birthday or 60th birthday whenever they feel that they want to retire. And what this does is gives them an annual charitable deduction and allows them to grow the charitable remainder trust portfolio tax-free so that when they do retire, they're taking a larger income stream off of that portfolio, just like they would with an IRA or 401k, any other qualified retirement plan. Also, it's a great idea for someone that's looking to contribute farmland or equipment or cars, whatever it might be, something that doesn't produce income, so that you put the triggering event as a sale of that unmarketable asset, so that while the CRT, the trustee of the CRT, is trying to sell that asset, they don't have to worry about any income problems or problems with creating a distribution, because there is no distribution from the CRT until that asset is actually sold and it becomes a standard unitrust at the beginning of the following year. CRT distributions are going to be taxable to your client when they are due and not when they are received. How the distribution from the CRT is characterized is all driven by the 4-tier accounting rules. So we could spend an hour just on this slide, so this is really going to be just a quick summary. The CRT distributions are taxed according to basically a worst rate first scenario. So as a CRT generates earnings throughout the year, the various tiers will be populated according to the type of income that was created. Then at the end of the year, the 4 tiers are used to characterize the distribution paid out during the year. So the ordinary income tier must characterize any distribution first, and then once it is exhausted, the capital gains tier will characterize the distribution, then the tax-free tier, and then finally the principal tier. But it's important to note that both current year earnings and prior year earnings will be in their respective tiers, including the capital gains realized when an appreciated asset is sold within the CRT. So for a client looking to contribute an appreciated asset and then invest in tax-free bonds to produce tax-free distributions, it is not going to work because the capital gains tier has been populated and must be exhausted before getting down to the tax-free tier. And unfortunately, this is a situation that we have seen many times over the years where someone will talk to their client about a great way to avoid the capital gains tax by contributing to a charitable remainder trust and get a charitable deduction. And by the way, we're going to invest in tax-free bonds and generate tax-free income and distribution, so there's no tax anywhere. And unfortunately, because of the way 4-tier accounting works, what the clients soon realize is they're going to be taxed at the capital gains rates until all of those gains realized from the sale of that appreciated asset that was contributed have characterized their distributions, which, depending on the amount of that capital gains, could be 5 years, could be 10 years before they see any benefit from their tax-free investments. And so that's a difficult discussion to have with the clients after they understood something completely different. So always have that in mind, how 4-tier accounting works. So here are some general guidelines for choosing investment options for a CRT. Obviously, publicly traded stocks, mutual funds, and bonds are going to work well. And this is because they're easily valued, easily liquidated, and can also be diversified very easily. Deferred annuity contracts can work well, but you need to be careful with some of the riders, such as the income guarantee riders. These riders may not produce the results you're expecting within a CRT, such as guaranteeing a specific distribution to your clients within a Unitrust format. Other investments are possible, but you just want to avoid any investments that produce unrelated business taxable income or maybe are very difficult to liquidate, such as a REIT or LLC interest, something along those lines. And again, if you have questions regarding the investment portfolio, you can always feel free to contact us, and we're happy to talk through that with you and let you know if we see any problems or not. Charitable income tax deductions. This just gives you a brief overview of how the charitable income tax deduction is going to be impacted by the various factors with a charitable remainder trust. Again, all these slides have a lot of information on them, and it's not designed that we're going to go through every detail in every slide, as you've noticed, but we want to make sure that you have all the information that you can refer back to it later on. So if you would like to have this presentation on hand for future reference, just let us know and we can get that out to you. But for charitable income tax deduction, obviously the less income that you receive is going to produce the highest charitable deduction. So a 5% distribution rate, regardless of the format that you choose from the CRT, is going to provide you with the biggest deduction. And again, you receive the charitable deduction on what the IRS projects is going to eventually go to charity. So if your client is receiving a larger income stream, that means less is going to be ultimately going to charity, which directly impacts your charitable deduction. The younger you are, the smaller the deduction. Again, that's because the income stream, even if it's only a 5% distribution rate, you've got several years worth of distributions potentially, several decades even, and that reduces the amount that eventually is going to go to charity. The older you are, on the opposite side, the bigger the deduction, since there's less years left. And again, keep in mind it is a present value deduction. So the fair market value, if you have $100,000 of IBM shares you're going to contribute to a CRT, that does not mean that you're getting a $100,000 charitable deduction. That means, what it means is depending on your distribution rate and the age of your client, we'll have to determine what eventually is going to go to charity based on the formulas, and that's going to be your charitable deduction. AFR decrease, the AFR rate or Section 7520 rate, this is the discount rate that the IRS requires us to use to determine the present value of the charitable deduction. And the lower that is, the more it's going to decrease the amount of the charitable deduction from a charitable remainder annuity trust format. This is why it's in today's low interest rate environment, it's very difficult to qualify for a charitable remainder annuity trust before that revenue procedure was released that we talked about earlier. But with a Unitrust format, a drop in the FR rate or a rise in the FR rate really doesn't impact it very much at all. And this next slide is just a nice tool that you can have on hand that gives you a quick overview of which charitable remainder trust format is going to be most appropriate for various situations. So say, for example, the current income, all the charitable remainder trust formats can provide current income. Obviously, the annuity trust and the Unitrust format are going to do a better job at that than a NIMCRUT or flip Unitrust will. But it also shows you for income deferral, if you have an unmarketable asset or hard to value asset, for multiple contributions, fluctuating income, and really easy to understand. It tells you which formats are going to be best suited for each of those situations. So now we're going to move on to charitable lead trusts. And in a lot of respect, the charitable lead trust is like the opposite of the charitable remainder trust, you know, as if you're looking into a mirror. So we're going to begin with an overview of the mechanics of a charitable lead trust or CLT. And the first step for a CLT is for the client to contribute assets to the CLT. And of course, as with the CRT, an attorney is going to be required to draft the trust document for the client and obtain a tax ID number. Now, if the client chooses to receive a current income tax deduction, this is going to follow the grantor charitable lead trust format. They're going to pay taxes on all the trust income during the term of the trust. And if the trust assets are designed or designated to an heir, this is going to follow the non-grantor charitable lead trust format, which is going to provide a transfer tax deduction, whether that be a gift tax or a estate tax, and that's going to be earned as soon as the assets are transferred to the trust. With the non-grantor charitable lead trust format, all the income is going to be the responsibility of the trust, which is going to pay for any taxes at trust tax rates, but the trust is going to receive an unlimited income tax deduction each year on the amount of income that's paid to the named charity. The next, the charity receives income from the trust for the specified number of years, and the amount paid can be a fixed annuity amount or a Unitrust amount. Unitrust amount being like the CRT that we discussed earlier, where the annual distribution amount is based on the annual value of the trust. And then finally, at the termination of the CLT, assets are transferred to the named remainder beneficiary, which could be the client for a grantor lead trust format or the heirs for a non-grantor lead trust format. This slide provides a quick overview of what, comparison and contrast with a charitable remainder trust, charitable lead trust. The key thing to remember with the charitable lead trust is that it is a taxable irrevocable trust. It's not tax exempt. So if you're ever looking to contribute appreciated assets to a CLT, definitely not a good idea because it will be taxed when the asset is sold within the CLT. So typically you're going to be contributing cash or assets that you do not intend to liquidate and that can produce enough income to cover any distributions during the term of the CLT. There is no 20-year limit on the term of years for a CLT like there is with a CRT. So if you want it to last for 1 year, for 30 years, for 40 years, that is possible with a CLT. And in addition, you don't have to worry about the 5% minimum distribution rate or 50% maximum distribution rate. There is no 10% qualification test for a CLT. and there's no four-tier system of accounting. And again, the income tax deduction is only if a grantor charitable lead trust format is chosen. The CLT can pay out distributions using either an annuity trust format, which is the most popular, or the Unitrust format, and we briefly discussed this in the previous slide. But the annuity trust format means the annual distribution is based on the initial contribution value, just like it is with the CRAT, or simply a fixed distribution amount stated in the trust document. And this format will never have a change in the distribution amount from year to year, and is the quickest method to achieve 100% deduction. But you can use the Unitrust format, and this is going to cause the distribution amount to change from year to year depending on the investment portfolio performance. But because it changes from year to year, it's never possible to achieve 100% charitable deduction. You can get very close, but you're never going to achieve 100%. So now that we've reviewed some of the characteristics that apply to all the CLTs, we'll now spend some time going through the two main CLT formats, and that's the grantor CLT and the non-grantor CLT. And the grantor CLT is really designed to provide the upfront income tax deduction to the client. And this format is typically used when a client has a large taxable event in a given year, such as the sale of a closely held business, a large bonus payment, or the sale of a piece of real estate. And the best course of action is to try and utilize tax advantage planning prior to the sale, for example, CRT again. However, sometimes the client does not mention anything until the sale has already occurred and then comes to you asking for advice on how to minimize the tax exposure. So this is where the grantor CLT can be a good plan B to try and offset some of the tax that has already occurred. Basically, the grantor CLT provides an income tax deduction equal to the present value of the future cash flows to the charitable income beneficiary. This is a great option as well for clients that make contributions to various charities each year in order to front load all those future contributions and future deductions into the current year when it is needed most. The downside of the grantor CLT is the fact that all investment income earned by the CLT each year is reported on the client's personal tax return, basically phantom income. So this issue may cause the investment portfolio to utilize some tax-free investment options to help minimize the impact of that. And then finally, at the end of the term, the CLT portfolio is transferred back to the client for them to use in whatever way they see fit. And since the client was paying tax on the CLT portfolio all along, there is no additional tax the client has to worry about when they receive the assets back. The non-grantor CLT is quite a bit different. Now, this format provides an upfront charitable deduction like the grantor CLT, but it is a transfer tax deduction for gift tax or estate tax as compared to an income tax deduction. And the reason a client would want to utilize this format is basically they're trying to get assets to their heirs at a reduced transfer tax cost. So this would be only beneficial for those clients that have a large taxable event, or if they want to get a significant amount of their assets to their heirs before they pass away and they want to reduce their gift tax. Any assets contributed to a non-grantor CLT are going to be removed from the client's estate, so long as they do not have any incidents of ownership which could cause the CLT to be pulled back into their estates, For this reason, it is always important to make sure that the client avoids serving as trustee and also avoids the ability to change the charitable income beneficiaries during the term of the trust. And typically, a client's going to rely upon their heirs, a family friend, or maybe even a charitable income beneficiary to serve as a trustee. So for the grantor charitable lead trusts, if the client did want to change the charitable income beneficiaries from year to year, it certainly is possible to do that. With the non-grantor charitable lead trust format, it's still possible to do that, but you just want to make sure your client doesn't have that ability and it's delegated to someone else. Because the non-grantor CLT assets are removed from the client's estate, the CLT as a trust, as a separate entity, is going to be responsible for paying tax on any investment income. But the good news is the CLT will also receive 100% charitable deduction equal to the amount of distribution it pays out to the charitable income beneficiary each year. For example, let's say the CLT investment portfolio generates $15,000 in income this year and distributes $13,000 out to the charitable income beneficiary. The CLT then would only have to pay tax on $2,000 of income at trust tax rates. So it is definitely possible to minimize the potential impact of the annual tax that's a responsibility of the trust with proper investment planning by trying to match up the projected earnings each year to what's being distributed out to the charitable income beneficiary. So this chart just gives you a quick overview of what the charitable deduction factor will be for various scenarios for a charitable lead annuity trust. And in here, we're using a 1.4% AFR rate, Section 7520 rate. So for example, if we wanted to create a charitable lead annuity trust with a 5% distribution rate and have it paid out for 20 years, we'd be able to claim a charitable deduction equal to 86% of the value of that gift. But as you can see, there's no 5% minimum distribution rate, so you could use a 3% distribution rate and have it go for 30 years, which would get you a 73% charitable deduction factor. So 73% of the value of that gift would be your charitable deduction. So there's a lot of ways that you can play with the factors that go into the charitable lead trust to accommodate how much income you want to pay out each year, for how long of a period of time, and how much of a charitable deduction you need. So if you only need a 20% charitable deduction, you can have it pay out less income for a shorter period of time. But this is a great chart to have on hand just to give you a quick overview of what it would be. So as we just discussed, the Charitable Lead Annuity Trust is going to pay out an annual fixed level annuity payments to charity for the entire term. However, this variable payout strategy changes the typical fixed level annuity payment by varying the amount of the annual annuity payment. And this strategy is often referred to as the Variable Charitable Lead Annuity Trust, or VCLAT for short. This has become growing in popularity over the last several years. And the key requirements of a VCLAT, as described in Revenue Procedure 2007-45, are it must have a guaranteed annuity amount, and the annuity amount must be determinable at the time of funding. So the key word is the guaranteed annuity amount must be determinable. The Treasury regulation for what qualifies as determinable is the exact amount which must be paid under the conditions specified in the governing instrument of the trust and can be ascertained as of the date of transfer. So basically you have to specify in the trust document exactly what the distribution amount is going to be for each year during the life of the VCLAT, the Variable Charitable Lead Annuity Trust. So these broad requirements allow a VCLAT to increase the annuity payment during the term, decrease the annuity payment, or both. For example, a 20-year term VCLAT could state the annuity payment is $5,000 for the first 3 years, $7,500 through year 6, $6,000 through year 10, and $10,000 through year 20. And the flexibility in varying the annuity payment in a VCLAT offers a few advantages over a typical run-of-the-mill charitable lead annuity trust format. The ability to pay out smaller annuity payments in the beginning with larger annuity payments later in the term dramatically increases the probability of leaving in a larger amount or even an amount to the remainder beneficiaries, whether it be back to yourself as the client or whether it be to your heirs. Another advantage is the protection of trust principal from poor market performance in the early years of the term. For example, if you look back at 2008, if you were able to create a VCLAT that pays out a very minimal amount, 1% or less each year, that gives the Charitable Lead Trust an advantage to being able to absorb the down market during its first initial years and not erode the trust principal, and then having a much larger annuity payment that has to be supported by an eroded investment portfolio. And then finally, a VCLAT also offers greater flexibility in setting the annual annuity payments to mirror an anticipated, maybe a variable in earnings pattern from a proposed investment strategy. So if you know you're going to have lower earnings in the first 5 years, maybe you want to set your income payments to be lower in the first 5 years to mirror that projected earnings. So we're quickly approaching the end of the hour, and what we would like to do at this point in time is just open it up for questions. We've seen a lot of questions coming through, and so we're going to try and address some of these as quickly as we can. And if you give us just a moment, we're going to scan through the questions, and we'll be back to answer some of these for you. Okay, we've had several questions regarding various questions. One of the common questions that we have received is related to contributions of closely held stock, and another set of questions is related to real estate. So we're going to talk briefly about the issues related to contributions of closely held stock when you're looking at avoiding the capital gains tax and utilizing a charitable remainder trust to do that. So there are quite a few hurdles that you need to be aware of when you're looking at contributing closely held stock, whether that be a C corporation, an S corporation, LLC, partnership. Each of them are going to provide different problems and issues that you need to overcome with charitable remainder trust. So the easiest one is when you have a C corporation that's entering into a stock sale scenario. You have a large corporation that's coming in to buy your client's C corporation. Very easy to do. It's treated basically like any publicly traded stock. The only difference is going to be that you have to obtain a qualified appraisal to substantiate the charitable deduction and substantiate the value of those shares for the contribution. If you have an S corporation, and let's say it's going to be purchased via stock sale, the first issue you need to be aware of when it comes to S corporations is that any time you transfer S corp shares to a CRT is a disqualified shareholder for an S corporation. So once a CRT owns S corp shares, it automatically reverts to C corp status. So this could be very problematic for, especially for an asset sale scenario. So say, for example, if you had an S corporation and then with an asset sale, you have someone coming in to purchase your client's company's assets, not the stock itself. So what will happen in that asset sale scenario with that S corp is now, again, it's reverted to a C corp. And now with the asset sale, the C corp is going to pay taxes first at C corp rates, and then it's going to flow through to the shareholder, where the CRT now as a shareholder is going to avoid that capital gains tax at the shareholder level. But what you have done is effectively exchanged a 15% capital gains federal rate for the sale of an S corp at an asset sale level for a 35% capital gains rate at the C corp level. And so again, S corps are much more problematic. You have to be very careful about how we structure it. If a large C corporation is coming in to purchase an S corp, and all the owners are on board with it reverting to a C corp, then we can make it work for a CRT. But it's very difficult to make it work. LLCs, you have to look at how they're taxed, if they've been elected to be taxed as a C corporation, S corporation, or partnership, and same rules will apply then. Partnerships, the key issue with partnerships is you have to make sure that any income that is generated by that partnership while it's owned by the charitable remainder trust is going to be considered unrelated business taxable income. Again, that's 100% excise tax. And so again, you just have to go into it with the understanding that we are going to generate some UBTI if there's income generated, but we're confident it's going to sell quickly and we can minimize that issue as much as possible. But irregardless, all of these are going to require a qualified appraisal to substantiate the charitable deduction. And we do have a pretty robust questionnaire that we can take you through so you can make sure that your clients are getting all these issues addressed if you do have a case like that. The other contribution question is real estate. And with real estate, there's a questionnaire that we will provide you to help you identify all the potential issues that could come up with a contribution like that. The most common issues that come up are debt. And anytime you contribute mortgaged real estate to a CRT and you sell that real estate within the CRT, the gain realized that's attributable to that debt is going to generate a 100% excise tax. So that's a scenario where you can create a worse tax scenario for your client than if they would have just sold it outright. And again, you want to look at the title, how that property is titled, if it's generating any income revenue, where that income is coming from. Rental income is exempt from the UBTI definition, but any other income is going to be considered unrelated business taxable income. So a good example of that when you got real estate is if you have a laundromat service or any other ancillary service with an apartment building that you're looking to contribute, that's going to be considered unrelated business taxable income. So another contribution question that came over was related to farms. Apparently there's someone that has a farmer that's looking to retire. Let's see here, children are not interested. What can a CRT do? We've had quite a few CRTs that were funded by farm equipment. So for example, whether it be a combine, whether it be tools, semi-trucks, anything that's involved in operating a farm, that can be titled over to a charitable remainder trust prior to going to auction. And then you can avoid the ordinary income tax on a lot of those tangible assets that are going to be taxed at ordinary income rates because of depreciation, recapture, and so on. So you're not going to get much of a charitable deduction with a farm equipment scenario, but you're definitely going to be able to avoid that ordinary income tax, which is going to take a big chunk of the proceeds out of that farmer's pocket for retirement. Farmland is a great asset to contribute to a CRT, get the fair market value deduction, and also be able to avoid all the capital gains tax on that as well. Triggering event options for the flip-CRUT. Just wanted to talk about that a little bit more. Again, just to clarify, the triggering event, the ones that we had listed on the slide are just the safe harbor triggering events that are stated by the IRS. You don't have to use those specific triggering events. You can come up with your own, but you do have to be able to document and prove that those triggering events are out of the control of the donor, out of the control of the trustee. Basically, the IRS doesn't want you to be able to take a a triggering event and be able to turn on a switch and say, oh, you know what, I need income next year, so I'm going to flip this switch or cause this event to occur, and boom, it's done. That's not going to work. So you have to be able to defend against that if the IRS ever questions it. Okay, so we've had a couple questions about the revenue procedure, talking about the Charitable Remainder Annuity Trust. And this revenue procedure is very new. It came out middle of this year. And this was, again, it was a game changer for the Charitable Remainder Annuity Trust. Historically, Charitable Remainder Annuity Trusts have always had the obstacle of the 5% probability test. The 5% probability test, again, says you can't have more than a 5% chance of exhausting the CRT assets before it reaches maturity. So with the low AFR rate that we've been experiencing for the last 8 years or so, this has been an unavailable option for anyone that's below the ages of 71 or 72. So this new revenue procedure allows the Charitable Remainder Annuity Trust to be available for all of these younger individuals. And basically with a promise that says, hey, I want to use a Charitable Remainder Annuity Trust. I want to make sure that I have a steady income stream. Let's say they're 60 years old, but they're retired and they still want that steady income stream that's not going to change from year to year. Well, they can use that annuity trust format now with that revenue procedure with a promise that says, hey, if I ever get to 10% of the initial contribution value, so for example, if they contribute $1 million to this Charitable Remainder Annuity Trust, they get towards the end of the term, and it's now valued at $100,000, well, now they have to stop receiving payments from Annuity Trust and pay out everything to the charitable beneficiaries. It's basically a promise to the IRS that says, hey, we understand you want at least 10% to go to charity, so if we ever hit that point, we're going to close down the CRT wherever we are, whether we're 75 years old, 90 years old, whatever time it is, and those proceeds are going to go to charity. So there's a lot more detail surrounding this issue. If you're interested in receiving more information on it, we're happy to send that information over to you. Okay, now there was a question regarding, what is the comparison of how many charitable remainder trusts are on the books versus charitable lead trusts? And that's a great question. Charitable lead trusts are definitely not as popular as charitable remainder trusts. There's approximately, I think it's around 98,000 charitable remainder trusts in existence, and there's roughly only about 6,000 to 7,000 of the charitable lead trusts. We, Renaissance Philanthropic Solutions Group, RenPSG, we administer over 6,000 charitable remainder trusts, but we only have approximately 600 charitable lead trusts under administration. And that just goes to show the charitable lead trusts are not as popular as a charitable remainder trust. They're not tax exempt. They can't avoid the capital gains tax. But for those clients that have an estate tax problem, or for those clients that need a large charitable deduction, larger than what you can receive on a charitable remainder trust, that's where the a charitable lead trust is going to provide some advantages and give you a charitable deduction even equal to 100% if you want it to, if you let it run out for a 25-year term. But at the end of that 25-year term, then everything comes back to them. So they get 100% deduction as if they gave it outright with a grantor lead trust, but they know that in the future they're going to get all those assets back. So it's like giving the assets to a charity to use for a period of time and then getting it back later on in the future. Okay, so at this time, it looks like we're coming up to the end of our time for this webinar. Again, apologize about the audio issues for any of you that experienced that. Hopefully we got that fixed for you. If not, we do have this recorded, so we'll be putting this on the website. And we're also happy to send out any material to any of you that would be interested in receiving it. We've received some requests, and we have your email addresses written down, and we'll be sending that information over to you. And if you need any other assistance, just feel free to give us a call. Thank you for your time, and I hope this was valuable for you to learn more about what charitable giving strategies can do for your clients. Thank you.